Good afternoon, everyone. Jen Toes, your portfolio manager here. I have David Zhao from my team going to give me a hand because we're going to do some non-fancy slides today because I wanted to make sure I could get this presentation out in a timely manner. So, what are we going to talk about? We're going to talk about market volatility and what I think is causing it. So let's start off at the beginning with some very, very big simplifications. However, I do think they describe investor behavior pretty well. So interest rates, what do we think? We think that if they go up, it is bad, and if they go down, it is good. Why is that? Because lower rates are easier for profitability than higher hurdle rates. Thank you. So next, let's talk about the Fed activity. If the Fed buys bonds, that's good because it's basically free money to the economy. So we like that. So what's happening? Okay, so in January, the US Fed is going to buy less bonds. That means less free money, but we're still on the free money side. And they will keep buying less bonds until they don't have to buy any bonds. That's no free money. They figure that's going to happen in about March. When you think about no free money, all they're looking to see is if the economy can manage on its own. And they're going to watch that for a few months. And then, if the economy isn't just stabilized but shows signs of improvement, they will potentially raise interest rates. Now, is this a change? Yes. You're going from free money to possibly raising interest rates. That creates volatility. But is this bad? Well, not necessarily. Because first of all, if you can get to here, that means your economy is actually doing what it's supposed to be doing and doesn't need any more of a hand. And when you talk about raising interest rates, what we're talking about, why you get that instant negative reaction, is because of the hurdle rate for profitability. But where are those rates today? Right now, the overnight Fed rate is about 0.07%. So let's say they raise it by 50 basis points and make it 0.57%. That's a hurdle rate of approximately 0.5%. I could tell you with a high degree of confidence that most businesses that are doing internal projections of profitability and analysis are not using 0.57% to see if they should invest in a business. It's going to be a number that's a lot higher. But I will tell you this as well. You could expect to see this in the headlines. Interest rates have increased by 800% since January. Remember, 0.07 to 0.57 is roughly an 8 times increase. But they're forgetting about the actual levels. And these are so low, that's what's important. And if the Fed can raise interest rates here in June, that means they can decrease them the next time there's a problem. They don't have to jump back to the free money. Is this timeline set in stone? No. The Fed tries to be very transparent to not shock the market, but as you can see, any type of change can create volatility, but that's okay too. We have investments in our account that are designed to make money from volatility. And as far as the magnitude of the current change in the market, where if I average the 3 markets, we're down about 5%. Roughly 3 times a calendar year, the S&P 500 has a peak to trough of about 10. So, you know what? Volatility is here to stay. I'm aware of it. Don't be too worked up about it. And as always, if you have any questions, please give us a call.